Hi, welcome to part 5, where we're going to be focused on operating leverage. We're starting on page 84, and just note that this part is going to include questions on, of course, operating leverage, but also financial leverage, which we covered in part 4. Okay, so operating leverage is always going to be measuring some ratio of fixed costs to variable costs. And we've touched on this briefly before, but in general, fixed costs are costs that don't scale with small or medium increases in sales. And for us, just so we have something definitive to say about it, we'll say that fixed costs are costs that can't be eliminated easily in one quarter. By contrast, variable costs are costs that scale linearly with small and medium increases in sales. And again, so we have a rule for it. We're going to say that these are costs that can be eliminated in a quarter. Okay. So operating leverage works in a way that's very similar to financial leverage in the sense that when we have higher operating leverage, we're going to have higher returns when sales are high and more bankruptcy risk. Financial leverage and operating leverage are not going to be completely independent, and interest, for example, is clearly related to financial leverage, but it's also a fixed cost. All right, so let's do an example showing how operating leverage works. Let's look at West End Advisors versus a Carpenter. And let's make sure that both firms have no financial leverage. So we'll say they're starting out balance sheets at beginning of year with each of them having assets of 100,000, no debt. So therefore their equity for each one is 100,000. They are going to have very different fixed cost, variable cost structures. So let's take a look at that. So West End Advisors basically has no variable costs. The costs that we have are we have to pay analysts, and we have to pay rent, and we have to pay for software subscriptions, and we have to renew our laptops every couple of years. And we have to do that whether we have a little bit of money under management or a lot of money under management. So all of our costs pretty much are fixed costs. So let's say 20,000 a year. For the Carpenter, on the other hand, she's going to have a mix of variable costs and fixed costs. So, for example, the more work that she gets, the more plywood she's going to have to buy, the more 2x4 she's going to have to buy, the more gas she's going to have to put in her truck, et cetera, et cetera. But she also has fixed costs, which are going to be things like lease payments on her truck, and she might have a shop, stuff like that. Okay, so let's say that to keep everything consistent, okay, let's say that when the revenue of the Carpenter's firm is 50,000, this is what her cost structure looks like. Okay, that she's got 20,000 in cost before tax, and that's split 50-50 there between there we go. That's split 50-50 there between fixed and variable costs. Okay, so now let's go through the good year, bad year, very good year scenario and see what's going on. So let's compare what we've got here for the two firms. We've got, let me get rid of that, okay. And let me just make a little more room there. So we'll say for a good year, each firm is making 50,000, and we're looking at the income statements for each firm. So in terms of variable costs, the West End, of course, is going to have none, and the Carpenter is going to have 10. And for fixed costs, we have West End with 20 and the Carpenter with 10. So their earnings before tax, it comes in different ways, but it's the same for both of them. So they both go through and they pay their tax, same amount of tax, and they get 22.5 thousand in net income. So the ratio of fixed cost to total cost for West End is 100%, and for the Carpenter it's 50%, and the ROE is the same for both firms. Okay, so far so good. So now let's see what happens in a bad year. So these are small firms, so things could get very bad very quickly. So let's say we're looking at something like revenue falling off a cliff to the tune of a 50% reduction. So that'll be the same for both firms. Okay. Now the carpenter's variable costs are going to go down because they scale linearly, right? By definition, with revenue, they're going to go down by 50% from 10,000 to 5,000. And she's still going to have her fixed costs of 10,000. But you see, West End doesn't get any benefit there. We still have to pay. We have to pay our rent. We have to pay for our software subscriptions. We have to pay our analysts, irrespective of what the revenue is for the firm. So what happens there? Our earnings before tax is 50% of hers, and our net income is 50% of hers. And so you can see she's in a much better position there. Now, her fixed cost to total cost ratio has changed because her variable costs went down in this bad year for her. But look at this, she gets double the ROE that we get. So maybe you're thinking, it's better to have a lot of variable costs. Well, maybe not. Let's look at what happens in a very good year. Okay, so let's say that revenue goes up from 50,000 a year to 75 in each case, and now the carpenter's costs have gone up linearly. Her variable costs have gone up linearly, and West End has experienced no additional costs. We're still at the same 20,000 we were in a normal year and a very bad year. So our earnings before tax is going to be larger than hers by the amount of her variable cost increase. And that's going to trickle down to, of course, whoops, let's see, we're having trouble with this. Okay, that's going to trickle down to the net income. We pay a little bit more tax, but because our earnings before tax is so much bigger, we have higher net income than her. And if we look down below here, we see that we have a significantly higher return on equity than she does. And our fixed cost to total cost ratio, of course, is unchanged as always, and her ratio has gone down a bit. Interesting thing to note here is that if we had an incredibly good year, we would still have the same just 20,000 in fixed costs, and our ROE would start to go way, way, way much higher than the carpenters. And what you find in the real world is that folks like venture capitalists who are looking at new companies, they typically are looking for high fixed cost to variable cost companies. Those would be companies with high operating leverage. And the reason for that is once you cover your fixed costs, all the rest of your revenue just drops straight down to the earnings before tax line. And the only problem, the only expense you have on that additional revenue is just your tax expense. And that's why, for example, both Microsoft and Facebook at different times, but Microsoft in the 1990s and Facebook around 2020, are so scandalously, wildly profitable, right? If we look at Facebook, its fixed costs are the cost of maintaining its software platform. That's its big cost, and then it has a little bit of cost in getting advertisers and stuff like that. But once they have paid for their software, all of their revenue comes in with no incremental cost except for tax. And that was true with Microsoft too, which is of course one of the things that made Bill Gates one of the 3 or 4 wealthiest people in the world. And same thing as Mark Zuckerberg is on the way to that happening for him. Okay, so that's the story there. Let's see, we have another question down here. Can the Carpenters and West End's revenues increase indefinitely without major structural changes to the firms? Well, as we've seen with West End, it pretty much can. I mean, after a while, when you're managing a lot of money, you have to take more people on to just spend time on the phone with the clients and things like that, but not too much. For the Carpenter, there's a certain point, probably around 75,000, where if she wants to increase her revenue, she's going to have to absolutely structurally change her firm and probably double her fixed cost. She'd hire another carpenter, that salary is going to be a fixed cost. She's going to need a truck for that carpenter, that's going to be another fixed cost, etc., etc. Okay. All right, so what are our key takeaways for operating leverage? Just like with financial leverage, higher operating leverage increases your ROE in good times, but it always increases your bankruptcy risk in bad times. And we saw that with West End Advisors there. In a bad year, we have to cover those fixed costs, no ifs, ands, or buts about it. And as we just saw on the previous page, most businesses can't expand to about twice their size without increasing their fixed costs. And then finally, some of the most profitable businesses in the world, like Microsoft and Facebook, have very high fixed to variable cost structures. And again, that's something if you're thinking about starting your own firm, something like that, and you're going to want venture capital money. Venture capitalists typically like firms with high fixed to variable cost ratios, so they can hopefully find the next Microsoft or Facebook. Okay, so how do we measure operating leverage? Well, generally accepted accounting practices do not require identification of fixed or variable costs, and for that reason, no one provides it publicly. Why not? You don't want to let your competitors know what that ratio is, right? So that's something you're going to know if you are inside the firm, if you're a CFO of the firm or working for the CFO, but you're not going to know as an outside analyst. So let's take on the role of outside analysts and let's see if we can approximate this. And we can actually. There's one and only one pretty good ratio for this, and this is the SDI to COGS ratio. So what we've got here is in the numerator, SDA expense, depreciation expense, interest expense, and in the denominator we have COGS expense. So think for a minute which one, the numerator or the denominator, has fixed costs, and which one, the numerator or the denominator, has variable costs. So you can think, the way I answer questions like this is I just look for something that I know, right? Definitely what jumps right out to me is cost of goods sold, that it represents inventory that we have sold, measured at cost. So the more inventory we have, the more COGS expense we're going to have, the more sales we make, the more COGS we're going to have. So that's clearly going to be a variable cost. So I'm going to vote for variable cost in the denominator. And let's see, what would kind of jump out at me is both depreciation and interest in the numerator, right? Our depreciation expense has really nothing to do with what our sales are in the quarter. They have to do with our strategic approach to our PPE, what kind of PPE we have and how quickly it's depreciating, that type of thing. Same thing with interest, right? Interest is absolutely not a function of sales. It's a function of how much debt strategically we decided to take out and what the interest rate was that we could get on that debt. Also, SDA is up here. SDA is usually something that does not have to scale directly with costs. It represents things like your accounting department, your HR department, and you should not have to increase their size as your firm scales up in size. All right, so what's this ratio doing? It's measuring the approximate fixed cost to variable cost ratio for a firm, which is exactly the amount of operating leverage. Bigger is going to mean more operating leverage. And remember, with all of these ratios, bigger is not better. Okay, bigger is not worse. In good times, having a bigger ratio helps you. In bad times, having a bigger ratio gives you more risk of bankruptcy. That's true for all the leverage ratios. And we'll come back to EBITDA. You see it's gray. We're not going to worry about that now. We're not going to worry about this ratio, which usually does not work very well anyway. And so let's go right into leverage ratios examples. So what I've got here is I've got for UAL and Love, I've got a return to their sales and sales growth information, but then also I have their financial and operating leverage ratios. So let's see what kind of questions have been queued up for us and see if we can answer them. All right, unless otherwise stated, consider past year on average. Okay, so whenever you see past year on average, that means TTM, right? So we're going to be looking at TTM numbers unless something else is stated. Okay, which firm has the higher level of debt financing? Okay, so now we're back to part 4, our financial leverage, but you remember, I'm sure you do. And there were basically 2 good ratios for measuring that. One was debt to assets, and the other one was debt to capital. Okay, heads up that debt to capital is my favorite. I think it's cleaner than debt to assets. Um, but anyway, other people feel differently and like debt to assets. They'll both always give you the same answer to questions like this, although the absolute value of the numbers will be different. All right, so I'm going to go with debt to capital here, and I want to compare my 77.18 for UAL to 23.36 for Love. So remember, this is debt divided by total debt plus equity. So bigger means higher financial leverage. It means more debt relative to equity. And so clearly, UAL has much more financial leverage. And like I said, you can see the same thing in the debt to assets ratio. So if I ask you a question like this on an exam, you can use either ratio and you'll get the right answer. Okay, if I ask you for a numerical answer, of course, then of course you've got to go to the ratio that I'm asking about. Okay, let's go back here. So which firm has the higher of, and that's going to be UAL from D to A or debt to capital, either one. All right, based on your answer to one above and sales trends for both companies for the past 2 years, which firm would you rather lend to and why? All right, so let's remind ourselves of the sales trends. So the sales are generally going up for both of these guys. We can see we've got high single digits, low double digits for UAL, and same thing, a little better for Southwest. And on a TTM basis, they look very close. So the sales trends for both firms are good and steadily upward looking, right? And on the other hand, we've got UAL has much more financial leverage, okay? So as we know, the more financial leverage gives you much more risk of bankruptcy. So the safer one to lend to is Southwest. Okay, so safer. So actually, before I even say safer, I'm going to give you the dread economist answer, which is it depends. Okay, and if you are an investor that is risk averse, right? Like the conservatives, when we did the conservatives and cowboys, then you'd want the safer one, and that's going to lead you clearly to Love because it's got lower financial leverage. Okay, and if you are a risk taker, okay, you want the riskier one, and I'll tell you why. And the reason you would want UAL is you can demand much higher interest rate. Okay, just imagine if you are Bank of China for a second and both of these companies come to you in the middle of the Great Recession looking to get a loan. Well, Love is a very conservatively run company. It doesn't have a lot of risk of bankruptcy, so you give it a fairly low interest rate. On the other hand, you know that United might flame out on you and you might wind up being the unhappy owner of United Airlines, which you don't want to happen. So to mitigate that risk, you're going to charge a much higher interest rate. And it just depends on whether you're risk averse or a risk taker. Okay, so let's see, 2A, verify the calculation of UAL's Q1 debt to capital and explain why this number is the same for Q1 and TTM. So to answer questions like this, we're going to have to go to the balance sheets for UAL. So let's just, before we do that, let's just see what this Q1 and TTM debt to capital number is. So 77.18%. So let's just remember that. Now let's jump to page 122 where we have the balance sheets and all the numbers that we're going to need to compute the debt to capital ratio. And let's go through and compute it here. So for Q1, remember these are balance sheets for UAL. So I've got Q1 in this column here, okay, right next to TTM. So what I want is total debt over total debt plus equity. Okay, so let's look here. They've got two debt lines, short-term debt and long-term debt. You always want total debt. Does not matter if it's short-term or long-term, you want it all. Okay, so we've got 466 plus 5323, 5323, and that's going to be divided by total debt, which is 466 plus 5323, and now I have to add total equity to that, which is 1712. Okay, and let's see what that equals. So I'm just going to take this and copy it, okay, and I'm going to bring over Excel here. Okay, and I'm just going to paste that into an Excel cell, and I get 77.18%. Okay, awesome. So we verified that number. So let's just put that in here. Okay, I might have had a slightly different number behind the decimal places here. That's because everything in this spreadsheet actually goes out to, 15 significant figures or whatever, and I'm always showing you just one decimal place. So there's going to be some rounding error, right, when we do this, but happily in this case we get the exact same number that was reported previously. Okay, so the next question is, why is the Q1 number the same as the TTM number? And I'm going to jump back to, well, before I jump back, you can see here that everything on the balance sheet in the Q1 column equals the TTM column, right, for assets and for liabilities and for equity, all right? And the reason for that is because balance sheets are always taken at a point in time, always the end of the period under consideration. So the end of Q1, that last nanosecond of Q1, is also the last nanosecond of our 12 trailing months. And because balance sheet numbers are cumulative snapshot in time numbers, just all comes down to what's the snapshot in time. Since these two are equal, the numbers are going to be equal. All right, so let's go back and answer that question. Okay, so why same? Okay, so we verified, yes, so same because end of Q1 equals end of TTM. All right. Looking at the past 8 quarters, has one or both firms' financial leverage position become more safe? Explain. Assume low inflation and stable bond market conditions. Okay, so this just means assume no big macroeconomic effects in the macroeconomic bond markets, the treasury bond markets and things like that. So we can just look at these numbers without thinking about maybe there's some weird macroeconomic effect that we're not seeing. So leverage position, good way to measure it would be with debt to capital. Okay, and I'm just going to breeze through here and look at these. And remember, debt is not specifically tied to sales, so we don't have to look year over year. You could look year over year. You would not get the wrong answer. But when they get debt, it's just going to happen throughout the year for these guys. So what I'm looking at is we've got 89, 94, 90, 85, 80, 76, 78, 77. Well, I'll tell you what, UAL has definitely gone down a lot, which is really surprising, right? Because they're this legacy airline with all sorts of problems, the high cost structure, et cetera. So what this means is they've been able to pay down some of their debt and become less risky, which is kind of shocking. All right, so let's see how about for Love. Love's actually increased its debt to capital a little bit. Its leverage position has increased, but certainly not nearly as dramatically as UALs has decreased, right? So 94%, 90% down to 77, 78%. That's a big reduction. Okay. So we say UAL has reduced its leverage position, or its leverage position as evidenced by reduction in debt to cap. And you could also look at debt to assets, and you would get the same answer. So that's really counterintuitive, but for those of us who were at the time looking at this company to see if maybe we should buy their bonds, that's a really good sign, because that's saying that management really is trying hard to survive and they're doing everything they can to help the firm. So that was a good sign. All right. Based on TTM figures, about how many years would it take for each company to pay off its debt if they could put maximum effort into this task? Okay, there's only one possible ratio that could help us with that, and that's that debt to EBIT ratio, which is measured in years. And remember, that's telling us how many years it would take for a company to pay down its debt if they could throw all of their EBIT at that, all of their earnings before interest and tax at that. So we're looking at last year on average. That means TTM. So boy, we've got some serious differences here. So it would take UAL more than 11 years. That's a long time. I mean, you don't know that because you're not experienced enough, but that's a long time. That's a little scary. 11 years for UAL and just a little more than 2 years for Love. Okay, so UAL is greater than 11 years. Okay, and for Love, it's more than 2 years. All right, and what did we look at for that? We looked at our debt to EBIT. And as always with that debt, that includes the total debt, short-term and long-term. All right, considering everything we've done so far, which firm is riskier and why? Well, that's sort of a very easy question. Clearly, UAL is riskier. Okay, it's got more financial leverage. It's not, remember, it was not consistently profitable. Okay, so definitely UAL is riskier. That does not mean that you should run away from it. It depends on what your position on risk reward is, whether you maybe want to invest in its stock even, or its bonds, or you want to go with something safer like Love. All right, so once again, this is a good place to pause. Let's pause it here. We'll come back and finish up this chapter with liquidity.